Private credit has garnered a tremendous amount of media attention and market focus in recent weeks. Artificial intelligence and its potential impact on software companies has, of course, been at the center of the storm. But how much of what's being written and talked about is actually signal, and how much might just be noise?
Of course, we're seeing headlines about AI risk, conflicts globally, and we're absolutely taking all of that into account. But really what matters is sticking to what we've always done, which is just fundamental core underwriting and building really diverse portfolios for our clients.
That was Bryan High, head of Global Private Finance at Barings. And this is Streaming Income, a podcast from Barings. I'm your host, Greg Campion. Coming up on today's show, Bryan High helps us make sense of this current period of volatility and what it means for long-term investors in direct lending strategies. Before we get into the conversation, remember you can follow Streaming Income on Apple Podcasts, Spotify, and YouTube. You can also follow Barings on LinkedIn, and while you're there, make sure to subscribe to our LinkedIn newsletter, Where Credit is Due, where we aim to recognize value across the people and portfolios shaping credit markets today. With that, please enjoy this conversation with Bryan High. All right, Bryan, welcome back to the podcast.
Thanks for having me, Greg. Good to see you.
Yeah, good to have you here. It's been a while since you've been on the show. So I thought maybe we would start with an overview of the platform that you oversee. I think for folks who are less familiar with you and our global private finance platform, it would be interesting just to hear about the size and the scope of that business. And then we can get into all fun stuff around software and volatility and everything else. But let's start there.
Sure. People call it lots of different things, but our moniker is Global Private Finance. That includes our direct lending business, sponsor focused, our capital solutions business, which has a little bit of opportunistic credit and specialty ABF in it. Those two businesses combined, as well as our BDCs, equal a little over $65 billion of commitments. We've got over 125 people working on that team. And it spans, a nice array of investment opportunities for our clients.
Yeah, great. Very global platform. We can talk about that. So big presence in North America, Europe, and APAC. And I think that's helpful just to understand the kind of size of the operation that we're talking about and the perspective, I guess, that you and the team kind of have across that whole platform. So let's get into it. Let's get into the kind of software AI whole volatility thing. Just right off the bat. SaaSpocalypse, yes. So obviously no shortage of headlines at the moment. Lots of worries about what the development of AI means for software companies and what that means for private credit portfolios. The headlines are coming fast and furious, and we're seeing a lot of volatility in markets, of course. Now we have the added component on top of that is a new conflict in the Middle East that we're witnessing kind of unfold before our eyes, and that is adding even more volatility to the mix. So I guess the question I have for you is, I'd be interested in hearing if you can kind of put this most recent period of volatility into more kind of historical context for us, given the number of cycles that you've seen in your career.
Sure. Yeah. I guess first of all, to acknowledge what you said about what's going on in the Middle East, just thoughts with our clients and colleagues there. Actually, we're recording this not too long after the attacks over there, and I did have a call with Waleed, and he's working from home, seems to feel safe, and feeling like he's in a good spot, but just hoping that ends quickly and peacefully.
Yeah, that's right. Yeah, Waleed Zamel, of course, heads up our operations in the Middle East. And, obviously the Middle East is a really important region for Barings from a business perspective. But I think kind of in times like this, there's more important things in business and investments. And, you think about people and you think about their families. So very much on our minds at the moment.
Yeah, leaning on the team. But getting to your question, I mean, in terms of headlines, I think we should sort of put this in context of big macro volatility impacting a market. You can think about trade wars, you can think about COVID, you can think about a rate crisis, the oil crisis, all these different events that have happened over the last decade plus. And in each one of those, sure, there was some issues in whatever particular sector, and in some instances across the board when we talk about rates, impacting portfolios. But and none of them did it just completely wipe out an industry. And I would make the argument that we're sort of in a similar boat as it relates to AI and software and in some instances services businesses that we're invested in. It's been a part of our underwrite for a while, and we can talk about that if you want to. But certainly, the acceleration of the technology is making you think again about exactly what the competitive moat that each one of your portfolio companies has. I think it does expose weaker business models, but the entire sector to just completely turn over and default seems hyperbolic a little bit in terms of maybe it sells newspapers, or I guess that means clicks these days
Yeah.
on the internet. But at the end of the day, I still believe fundamental underwriting and good companies will come out of this potentially even stronger with the benefit of AI.
Mhm, mm. It seems like there's a gap between, what we're seeing in the headlines, maybe it is to sell newspapers or, website views or whatever, but that, what you see in the headlines and then, when you talk to people on the ground in the industry, kind of what the reality is, there's some nuance lost there, and I feel like this isn't necessarily just, specific to what we're seeing in software right now. It's maybe broader. We saw, First Brand, a lot of reactions to First Brands last year, for instance, and then there was some more nuance to that story. Is that consistent with how you're thinking about it?
Yeah, I mean, I look if you, I think everybody wants to lump all of these headlines into something that is all correlated. I would argue First Brands, when you sort of peeled back the onion, a lot of that was syndicated debt. Certainly, there was some aspects of private credit, but most of the risk was held by syndicated loan participants. And it was driven by fraud.
Mm.
So I don't necessarily think that the narrative that's out there is what we're seeing in our book. Certainly, when we think about the risk and the performance of the underlying assets in our portfolios, I do think it's great reading, and you see these headlines sort of drive behavior at the underlying investor. Depending on the type of investor, some of our larger, sophisticated institutional investors, that this isn't new news to them. They sort of understand the difference in underwriting with different managers. But when you're a retail investor and you're reading headlines, you're going to start asking questions because you're not in those weeds. You're not paid to be in those weeds.
Mhm, mhm. Yeah, that makes sense. Now you talked about the underwrite. Talk to me a little bit about, um, how you and the team have thought about AI risk, when you've underwritten software companies in the past, and maybe, like, how you feel about the exposure that Barings has today.
Yeah, I guess I'll start with from a sector perspective, we're relatively underweight to what we see in some of the publicly available information of some of our peers. We've always been relatively conservative, really across all sectors, but software included in that. So we haven't built a business on annual recurring revenue loans or ARR loans. We're not 8, 9, 10 times deep in a capital structure in the loans that we're involved in. And as we've underwritten these deals, typically number one key risk, AI, and what does it mean? Now again, I'll be the first one to tell you, 3 years ago when we were talking about that, it doesn't feel the same as it does today in terms of what that risk profile looks like. But I think the way that we've underwritten, the fact that all of our companies have some sort of competitive moat, whether that's on the data side or something else, we feel, and we've gone back and looked at them and underwritten them again. We feel really good about the underlying risk. I actually think from a services side of the business, there may be um, a larger risk that AI could eliminate certain roles, whether that be in accounting or legal or something like that. But some of that's around adoption as well. So it's really making sure that you're partnered with the right sponsors, that you have the right capital structure, that you've thought about all those risks, and that those businesses are positioned to sort of deal with whatever comes in the next couple of years as it relates to AI.
Yeah, that makes sense. I mean, I think that the concept of having some humility around this is, which it seems like you and the team really do, resonates with me because I think anyone trying to sit here today in 2026 and say, okay, this is exactly how AI is going to impact this industry, right? Software happens to be the one really in focus right now, but like you're talking about some of these other industries, and the reality is like we all just don't know yet. Like there we can make really good educated guesses around, what's going to be disrupted, what's not, where there's going to be job growth, where there's going to be job destruction. But they are, somewhat guesses at this standpoint. And so the idea of kind of sticking to your knitting, focusing on your traditional underwriting, everything that you guys do in terms of diversification and um, really in-depth credit underwriting, I think seems logical, the way to handle it. One question I have for you is, feels like for years now we've been talking about the next credit cycle, right? So when does the credit cycle happen? Arguably, we haven't seen a real credit cycle since the GFC. Here we are today in 2026, and I don't know if you're prepared to answer this question or not, but is AI the catalyst that kinda tips us over into seeing an actual credit cycle here?
Probably every time I've come on this podcast, I've talked about how it feels like we're towards the end of a credit cycle, but the economy has sort of continued to hum along. I think whether or not AI tips us into a credit cycle, I'm not sure. But what I am seeing and feeling is, you want to definitely be positioned in an appropriate way to the extent we are heading into that cycle, and having a ton of exposure to the underlying consumer is probably not a great place to be if that's where we're headed. So again, constructing portfolios in a way that has diversification not only by borrower but by sector,
Mhm.
and thinking about your loan to value when you're underwriting these deals, and where your leverage metrics are and their ability to sort of service debt in a high interest rate environment. I think all of those all of those things are just sort of core to what we do,
Mhm.
and we underwrite every deal as if we're going to go through a cycle. Again, partnering, especially on the direct lending side where you're par dollars, partnering with sponsors that you have seen go through tough times, whether that's idiosyncratic or a cycle, is what you want to be doing in a time like this. Have a platform that has a track record,
Mhm.
has those relationships, and has demonstrated their ability to uh, you know recover as much as they can in those situations. And I think we have a really talented team and a lot of experience in various cycles, whether that be on the capital solution side or the direct lending side of the business.
Okay, yeah, I wanna get to the capital solutions in a minute, but let me just ask you a little bit more detail about the idea of portfolio construction here. So you're constructing portfolios, you said you're kind of your thought when you're underwriting credits is you're kind of expecting to for the investment to play out over the course of an entire cycle. Um, so you're really thinking long term. You mentioned not wanting to have really exposure to the consumer, but just talk to me a little bit more about that. I think Barings probably has a reputation of being maybe a bit more conservative in terms of capital structures and leverage and things like that. But just talk to me a little bit more about the idea of just building resilience into portfolios.
Yeah, I think the simplest way to think about it, regardless of the geography that you're in, is th- the more granular you can make a portfolio, the better. You're not going to bat a thousand. Nobody does. There's going to be something idiosyncratic, or there's going to be something cyclical that's going to create issues within a portfolio, and you don't want any one specific issue to drive the overall performance
Right.
of your portfolio down. So it's getting as granular as you can, and finding as many good assets as you can, and thinking about each sector from what are the drivers, and what are the potential issues that could push a sector or a company into stress or distress. And then what are the levers that you can pull to ultimately get out on the back end if you don't have a sponsor that's supportive at the end of the day.
And so what are the sectors that you would avoid no matter where we are
Yeah, I
in
mean, I
this?
think most direct lenders say that, restaurant, retail,
Mhm.
oil and gas, energy related, sort of commodity driven businesses. Those are the types of businesses that, in my opinion, don't really fit well going through a cycle.
Mhm.
And so those are just industries, on the direct lending side of the business that we tend to avoid.
Okay, and then diversification, which I think you've already kind of talked about. Obviously hugely important, not wanting to have, any large concentrated, um, allocations to any particular sectors.
And I think that's, easier said than done. It's really difficult, particularly in other geographies like Europe. You see much more concentrated portfolios, but for Barings, we continue to have, 100 plus names in our portfolios, trying to make sure that, again, there's no one specific driver of performance
Mhm.
within the book. It's driven by a consistent approach across a diverse number of borrowers.
Okay. Now let me ask you this. So if you take a more conservative approach through a cycle and you're trying to avoid concentration risk in any given sectors, are you at a competitive disadvantage ever? So meaning like, is Barings losing out on deals because let's take the last couple of years. There's a ton of software deals in the market, and maybe leverage is getting a bit more above where we're normally comfortable. Are we losing out on deals, and how does that dynamic work?
Are there deals that we could have in our portfolio that we don't? Yes. And we're okay with that. I think it's our job to make sure that we're as patient capital as we can be, obviously deploying in markets all the time because that's what our clients, it's a core allocation. That's what they want us to do. But thinking about positioning those portfolios appropriately for where we are in a given cycle. And again, for better or worse, we're credit people, so we just believe around the corner is the next worst thing, and we
Yeah.
need to be prepared for that. So that's sort of how we think about underwriting each one of these deals and trying to max out leverage to make sure that either A, we're deploying enough capital in a specific deal for it to make sense for the business side of what we do on our P&L. That's not necessarily the way that we think about it, because if we can perform well through a cycle, we will survive that cycle and we will be stronger on the other side, and there will be fewer competitors. And then, yes, you'll see really attractive opportunities. We've seen that, after COVID. We
Mhm.
saw that, where you could invest at 4 times with 650 over. There will be those times again. In the times where spreads are tighter and it's really competitive, you just need to stay disciplined so that you don't wind up ruining your reputation, so that when that next opportunity is there, you're still there to take advantage of it.
Mhm. Mhm. Always looking at what could go wrong. Credit investors, not necessarily the most fun people to have at parties, but good to have
It's true.
investing your portfolio for you. All right, so let's switch gears a little bit. I want to talk a little bit about the kind of global landscape that we're seeing. So Barings platform, as we kind of talked about up front, very global in nature. Large teams on the ground in North America, Europe, and APAC. Maybe before we talk a little bit about some of the specific opportunities in those regions, curious just are there actual tangible benefits of having a global platform like that versus, for instance, being a regional player? I know, there's a lot of direct lenders that focus on one specific geography or one specific segment of the market. Just talk a little bit about that kind of concept of global.
Sure. Yeah. I mean, I think the first thing that comes to mind, probably the easiest answer, is relative value. Just thinking about where spreads are across the globe, where leverage levels are shaping up across the globe, and being able to compare that in a setting with leaders talking about how we should be positioning portfolios, and especially if we're thinking about a global mandate, where should we be allocating capital across the globe? Um, obviously that's very important. I think having 125 analysts instead of 45 analysts in one geography, those trends in software are true in, the Nordics as they are in, the Southern United States. It's all the same drivers and same sort of nuances that you would see in credit here in North America will find its way into Europe and Asia Pac. And so, being able to sort of take lessons learned on credits here or sectors here, is super important. So that's sort of the execution side of the tangible benefit, if you want to think about it
Mhm.
that way. The origination side is more and more sponsors are also thinking to themselves, where can I go find good value? And sometimes that might not be in the US, where there's a lot of dry powder to put to work, or they have a portfolio company in the US and they want to expand globally,
Mhm.
and we can be that partner across the globe. So
Mhm.
if
Mhm.
I own a sort of a platform here in North America, I want to expand into Europe, there's an opportunity for me to go buy something there. Chances are we can provide a financing solution for both sides of the pond in two different currencies for the exact same borrower. And not everybody can do that. I think that is relatively unique to our
Mm,
platform.
mm, yeah. All right, let's talk a little bit about North America. So obviously, we're seeing a lot of the impact of all this rhetoric around software here in North America. Uh, Also have a big dynamic around retail money that's been raised in the asset class and seeing some volatility around there. So just talk to me a little bit about the competitive environment that you're seeing in North America and kind of what you're expecting in the months and years ahead.
Yeah, I mean, if you look at where the North American market has come over the last 5 years, it's pretty amazing. But with that comes certain consequences, and you've seen the market expand into much larger businesses competing with the broadly syndicated market. You've seen at that end of the spectrum, the spread premium compress somewhat. You've seen the terms and the documentation sort of merge a little bit more with what you see on the broadly syndicated side of the business. Um, but that's a function of the fact that all this money has been raised and it needs to be put to work in a relatively short amount of time. You referenced some of the noise in the market and the headlines around flows from the retail side and sort of all this fear that's taking place within that retail market. You've seen some redemptions take place in BDCs, and I think what that ultimately means for the North American market over time. I think retail will continue to exist. It'll still be the wealth channel will still be a good place for managers like ourselves to raise capital and put money to work in private credit. I just think that it could mean that from a spread perspective, there could be a lot of fits and starts. When everything's humming, it's sort of a relatively stable market, albeit competitive. And then when things start to pull back, you may see that marginal buyer in the retail market drive spreads back up. And so it'll be interesting to sort of track how things price over the next couple of months, not just in the software sector, for example, but across the market, because there'll be um, fewer of those marginal buyers in the market looking to put something to work in a given month because they just raised money in the retail channel.
Now, if that marginal buyer kind of is removed from the equation for a certain amount of time, does that result in kind of a more rational market, so to speak, pricing wise? And does that actually end up being an opportunity for managers like Barings?
I think it is an opportunity. We're not solely driven by retail flows. We have, over half of our business is built off foundation of commingled fund and separately managed accounts for institutional investors. We have our BDC franchise, which is both institutional and retail in terms of our investor base, which makes up another 20% of the business, and the rest is our sort of parent balance sheet as well as our CLO franchise, which continues to grow and is starting to issue in new geographies outside of North America, which you've helped us sort of splash all around LinkedIn and other places. So I think that having that stable capital base is a benefit to our platform to take advantage of all the things we just talked about, where spreads may widen, where documentation is improved, where credit metrics are more conservative.
That makes sense. So yeah, if you have that really diverse capital base, even if retail pulls back, you don't need to necessarily pull back from the market if there's attractive opportunities.
And that benefits our investors. It also benefits our sponsor relationships because we're not in and out of the market. It's deals take a while to close. You're not going to see us change what we're saying, in a 2-week period just because there were outflows from one of our vehicles, for example.
Yeah, yeah. That's kind of certainty of capital that you're going to be there throughout the cycle. I'm sure it's huge with sponsors. All right, let's shift gears, talk a little bit about Europe for a second. So different market, different sort of structure and different competitive landscape. Talk to me just a little bit about what you and the team are seeing in Europe today.
Yeah, I think fundamentally it's just a different market. Most of the market is still traditional, core middle market lending, although there are some larger cap deals that are starting to get done, and that's a growing part of the market. Um, there are just fewer competitors that can take down an entire transaction in the European landscape. There are certainly participants in deals, um, but in terms of the number of competitors that we see that can come in and say, we're going to lead this deal, we can take the whole thing down, more and more they want to club us together with a couple of lenders, in a given deal. But the ability to actually speak for it is key in sort of winning a transaction. And that market hasn't matured enough to a point where it's as competitive as we have here in North America. Wealth is, starting to take hold there as well, but we're in the very early innings of that relative to what we've seen over the last 5 years here in North America. Other nuances, I guess, that I would point out as it relates to Europe versus North America, I think is around how you originate. Um, Being able to speak in whatever language that given country speaks
Mhm.
is important. Your
Yeah.
documentation in some instances is in French.
Mhm.
You better be able
Mhm.
to speak and read French to effectively negotiate the documentation. So it's a little bit more regional than what you would see here in North America, and therefore you sort of have to be able to both originate and execute in each one of those regions with a certain type of team. And so being able to be consistent across the region and approach, I think is really important, but also, feel local, if that makes
Yeah, yeah,
sense.
yeah, yeah. Same consistent approach globally, but you have to have that regional nuance, and it's hard to originate these transactions. In France, sitting in New York, or even in London, right? You need the local teams in Paris, in Berlin, Frankfurt, and in all these locations around Europe. So that makes a ton of sense. All right, last one, Asia. Another different market, another set of competitive circumstances and market structure and all that. How are you and the team thinking about Asia today?
Yeah, so we're focused on the developed parts of Asia. Most of our business is based in Sydney, with some folks in Hong Kong as well. I think having an approach where we can lean on the legal infrastructure, the jurisdictional issues that are born out of Europe has allowed us to sort of quickly grow in that market, and again take a very consistent approach in terms of the way that we underwrite, the types of deals that we're looking for, the types of sponsors we want to partner with. That's just another arrow in our quiver. Again, if you have a European business and you want to expand into Asia, we can help you do that. Same with North America to Asia, all three in some instances. So I think the origination is global,
Mhm.
and it can originate for any region and pockets of capital that we have across the platform.
Mm. All right. So you talked about, looking at global relative value across regions. By the way, I should ask you, are there any of those regions that are jumping out today as particularly offering relative value?
Yeah, I think there's still a premium from both a fee perspective and a spread perspective in Europe, and I would argue that same spread premium exists in Asia Pac, and maybe slightly higher on the fee side in Asia Pac for the given transaction. Asia Pac is interesting, especially if you're focused in sort of Australia as one of your key jurisdictions. Most of the borrowers that are middle market there are national champions. They're large companies
Yeah.
locally. So, I would almost argue that the risk adjusted return of that region might even be more attractive than what we're seeing in Europe right now. But, in general, I think those we're seeing a lot of clients ask about, hey, how can we get exposure to other places outside of North America? And I think there's a good case to be made that you can pick up a little premium in those geographies today.
So looking at we're talking about looking at relative value across the globe from a direct lending standpoint. If you zoom out and you say, okay, let's look at relative value across credit markets, full stop, right, including public and private credit markets. Barings obviously has a large global platform across public and private, including a $95 billion plus high yield and CLO platform, one of the biggest in the business. Um, how does that affect how you and the team kind of assess risks, find opportunities? Curious kind of what some of the benefits are of being able to look across that whole entire credit spectrum.
Yeah, a great question. I think you know I earlier in my career, had a ton of exposure to that franchise, and I think that the underwriting sort of fundamentals that we have on the global private finance side mirror what we do on the liquid side of the business too. Obviously, there are nuances. There's a lot of technicals. And we're purely focused on fundamentals on the global private finance side. You sort of got to be in touch with where the technicals are
Mhm,
on
mhm.
on the on the liquid side of the business. We have a great team of analysts that do that. I think for us, we would be tone deaf if we didn't have this unbelievable resource that we could tap into and ultimately understand where is risk being priced in the software market today based on all these headlines, and how should we be thinking about the marginal next deal that comes in that might have some sort of AI risk relative to what an investor could get in the liquid markets. Um, we talk about the illiquid market typically being 6 to 8 weeks behind from sort of a catching up as it relates to where things are pricing.
Mhm.
And I think that has a lot to do with timing of closing of deals and when you've committed and all that type of stuff. So you don't really see it hit the tape until a deal closes. But I think that that's an important place for us to be thinking about pricing risk, thinking about how your relative value across markets should be considered. And then you've got sector expertise. Brad Lewis, who covers software, has been doing that for over a decade. He's very, very good at what he does. He's in the weeds. He knows everybody in the market. He knows management teams. He knows sponsors that focus on that, both at the lower end and the upper end of the market. So just being able to sort of get in touch with him, compare notes on what we're seeing in our underlying portfolio companies, what he's hearing in the market, because he lives it every day from both management teams and industry experts, is an invaluable resource that if it was just us on our own, we wouldn't be able to take advantage of. So I think that is again, a unique part of being part of a large platform, a global platform that sort of sees everything that's going on in the market.
Yeah, and of course, we see credits migrate it from public to private markets and vice versa, so you can kind of follow credits and management teams across that whole spectrum. I wanna talk about the kind of the opposite end of the spectrum from the public credit market and to what I think is kind of at the other end of the spectrum, which would be kind of highly customized, truly kind of bespoke, structured capital solutions, and that's what we call a group called Capital Solutions. Um, Tell me about that, 'cause you're as part of this global private finance platform, you're overseeing our capital solutions group as well. That's under your umbrella. Tell me a little bit about that, how it's kind of how you think about it, whether it's like a complement to direct lending or how you're thinking about that business overall.
Yeah, I do think about it as a complement to if you think about direct lending being a core allocation in portfolios these days for most institutional investors, this is sort of a satellite of that. So, if you're building a book of private credit, the the big chunk of it's probably going to be direct lending. Where else can I get private capital risk and return that is complementary and a little less correlated to sponsor backed, LBOs, for
Mhm,
example.
mhm.
Um, I think our capital solutions business is an interesting take on it, in that a number of platforms have that business. A lot of them, it just means junior capital. Ours is about 3/4 of what we do is senior secured risk, um, and we're looking to sort of achieve 250 to 500 basis points of a premium to what you would get in a direct lending
Mhm.
deal. What is interesting risk adjusted return where we can put, a structure around it to protect ourselves and deploy capital in a way that is, um, again, able to drive return that's above and beyond what you can get in direct lending in a responsible way with a lot of structure. And again, that's why this business isn't necessarily as scalable as direct lending and why it's a satellite allocation. You're not going to have a $50 billion fund that can do what I just
Mhm,
described
mhm.
in a responsible manner. But it's evolved into more specialty ABF financing,
Yeah, I was
specialty
gonna ask
finance
you, so this
entities.
is this is both kind of corporate lending
Yeah,
as well as
yeah.
asset-backed,
Think
right?
about it as opportunistic credit to corporate issuers. And more, a growing part of that book is sort of specialty asset-backed finance, in more esoteric asset classes or financing specialty finance businesses. That's a a very interesting part of the market that, again, I think is sort of the next frontier that
Mhm,
an
mhm,
institutional investor could allocate to within private credit
mm.
to generate a little bit different return and a little less correlated to what you already have in your book.
Okay, okay. I'd love to go way deep with you down that rabbit hole, but I'm thinking maybe we'll do that in a separate podcast, or maybe I'll bring Mike Searles on to go deep down
There
that
you
rabbit
go.
hole and
Yeah,
talk all about that. But
get him in the hot seat.
that seems like a really interesting space right now. All right, I'm going to bring this discussion to a conclusion here. I want to ask you just a couple finishing questions. One, what's clear to me is that the kind of disciplined approach, the kind of global reach of the business, the cross-platform insights, whether you're talking about, across public and private, across the globe, et cetera, it seems to be resonating because your teams have had a lot of success raising capital, um, even in the last 2 years alone. Talk to me about what you think is driving that fundraising momentum.
Yeah, look, I think it's a function of the team. We have a fantastic team that has demonstrated a consistent approach. It's you know driven results. We've been able to um, work with our clients to create in some instances bespoke mandates that meet their needs. And then also we've been creative in terms of how we've wanted to partner with various institutions, and I think it's allowed us to again continue to be ever present with our sponsor relationships and our various counterparty parties where we source deals, and just continue to show up in a very consistent, humble but thoughtful way, and provide financing solutions. What we do isn't necessarily all that sexy, but people like working with people that they like working with, and they want to make sure that they can trust the capital providers. And I think the DNA of this institution and our parent company is exactly that, and it's the type of capital partner that a lot of institutions are looking for.
Mhm. And do you think a lot of those institutions that we partner with, do you think, I think a lot of them, like us, kind of take a long-term, through the cycle approach. Do you get the sense that um, they think of private credit in all the different flavors that we're discussing, talking about it? Do you get the sense that they think about it as like a really long-term core allocation? I mean, the
Yeah.
fundraising momentum would suggest so, but I'm just interested.
Absolutely. I
Yeah.
mean, yeah, this is now mainstream part of the portfolio. It's another element of fixed income where you can pick up a premium to what you can get in a more liquid asset class. I think it's here to stay. I think um, you know, people want to partner with scaled institutions. We happen to focus on the traditional middle market and one of the largest players in that part of direct lending, and I think that gets us a lot of at bats. I think the fact that we're part of a large institution that can provide a number of different bespoke um, sort of fund structures and or mandates to clients looking to partner with fewer asset managers, again, is sort of an enviable place for us to be talking to them just about direct lending, but also as part of a broader solution that Barings can offer overall.
Yeah, makes sense. All right, last question. Looking ahead over the next, let's say, 12 months or at least through the rest of 26, what do you think investors should be keeping an eye on?
I think it's going to be really, I mean, you've already seen it in some of the headlines that we were talking about, just the dispersion amongst managers. So just watching performance and seeing how people behave and seeing how people deal with some of these headlines will be very interesting. But I think the more interesting thing that investors should be focused on is what are those underlying portfolios actually doing? How are they performing? What are your non-accrual rates? How much PIK do you have in your portfolio? Um, how are you dealing with issues that are needing to be restructured? What are the recoveries on those? Sometimes it takes years for all of that to play out, but
Mm,
frankly, our firm is built for this. Our parent company has been built for this for a
mhm,
very long
mhm,
time,
mhm.
and so if we are heading into some real credit cycle as a result of AI or a conflict or just it's been 20 years.
Yeah, yeah, probably a healthy thing for the
I
market
I think
in
so.
the long run. Yeah,
Yeah.
okay. But I think, as you point out, and kind of to put a bow on this discussion, it probably is a lot less about the headlines and the sensationalism, and it's more about pulling back the curtain and looking at the underlying portfolio and really understanding what you own and kind of sticking to your knitting, long term, even if it's not always super exciting.
Yeah,
Um,
exactly.
All right, Brian, this has been awesome. Thanks for sharing some insights. I feel like we always get a really balanced, measured view from you, which I think is exactly the type of view you want from someone operating in this asset class. So I really appreciate it.
Appreciate you having me on.
Thanks for listening to or watching this episode of Streaming Income. If you'd like to stay up to date on our latest insights across alternative asset markets, including public and private credit, real assets, and more, please follow the show and leave us a review on your favorite podcast platform. We're on Apple Podcasts, Spotify, YouTube, and more. And don't forget to follow Barings on LinkedIn and subscribe to our newsletter, Where Credit is Due, for our latest updates. Thanks again for listening, and see you next time.